0.5%. 0.5%. That's half of a percent of the average portfolio is hedged with gold.
Wow.
It's nothing. The move is to 3,000. That's where we're going. You can see silver going up by 100, 200, 300% on nothing.
Are you just a little discouraged about gold and silver so far in 2024? Well, I'm going to give you 3 reasons why 2024 is still looking insanely huge for gold and silver.
The worst day on Wall Street since the crash of 1987.
We're now down 43%.
This could be the most serious recession in decades.
Protect your retirement with a gold and silver IRA. Learn more at sdbullion.com/IRA. Hey everyone, thanks for watching Yankee Stacking. Yeah, I do think this is still likely the biggest year in precious metals since the massive run-up we saw in 2011. And Lior Gantz of the Wealth Research Group agrees. Let's ask him for 3 reasons why. Hi, Lior. Great to see you again.
Great to be here.
All right, let's get right into it. Last December, Lior, you told me to get ready for a huge year for precious metals. Also mining stocks. You mentioned that too.
Absolutely.
Yep. You were like, Yankee, strap yourself in, man. Get ready. This could be huge, could rival 2011. This is what we have been prepping for, remember?
Mm-hmm.
Could you give me the 3 reasons, just 3, why you think this is the year still?
Reason number 1 is what's called the equity risk premium. Essentially, stocks are cheap when the bond yield is very low and the S&P 500 is cheap. Right now, it is the most expensive since August of 2000, right before the dot-com bubble burst.
Wow.
And the when it was second most expensive was in 2007, right before the GFC. What's actually put this on steroids is the fact that in 2022, hedging your stocks with bonds did not work. The need to hedge your portfolio is drastically high. Investors have a memory that bonds will not be that hedge. So where do they go? They go in gold. That's reason number 1. Reason number 2, the entire investment community is concentrated in 7 stocks going on 3. The last time portfolios were this concentrated was in August of 2000, right before the dot-com bubble burst. In other words, and this is, by the way, what really made my skin crawl is that Ken Griffin of Citadel raised this issue as well. To me, that's a top 5 investor of all times. So he said, the biggest risk we have is that everybody is invested in the same thing. So it's in Microsoft, NVIDIA, and Meta. In other words, the 7 are even more concentrated now, and it's just 3. My point here is that the need to hedge is incredibly high. And then you look at the third component, which is cutting interest rates. And what I think people need to understand here is that the market is already pricing in a lot of cuts. Stocks are already priced for 5 rate cuts of a 0.25% by the end of the year. Gold is not pricing that in, being that it's an hedge and not a productive asset. The rate cuts are coming. What Powell is grappling with is the fact that once you start cutting, going back to pausing or hiking is a suicide. So to wait and see in March and just pause it, and then in May you can cut 0.5% instead of 1/4 if you need to, it's fine. I think that once they start cutting, you will see that inflation continues to come down and settles above the 2%, settles towards the 3%. And that is a drastic difference for investors.
Isn't that the new normal now? Aren't they just going to say
Exactly.
that's 3?
If
That's our target rate, right? 3.
they will slowly, in the next 4 or 5 years, bring that idea along. And in a world of 3% inflation, you really need to keep a constant hedge in your portfolio. Do you understand that only 0.5%, 0.5%, that's half of a percent of the average portfolio is hedged with gold?
Wow.
It's nothing. So in 2011, at the height of it, it was 0.85%, not even 1%. And so my point to you is that you can see silver going up by 100, 200, 300% on nothing. These three things really make gold super compelling. But I want to tell you not about a fourth thing, because I know you didn't ask, but I want to tell you why gold looks so strong right now. Everything that you're seeing in the first 30 days of the year is about how robust the economy is, how resilient the consumer is, how tight the jobs market is. Every one of these is supposed to be like a wrecking ball for gold. And where are we after all of this super hawkish news? We're at 2,045 an ounce. After all of this,
Amazing.
this tells me that the weak hands have left, and that whoever is selling right now is selling at these prices and not any other prices. And whoever is buying it as a hedge. Therefore, he doesn't need to buy it on a dip. He's not buying it for the investment opportunity. He's buying it because he needs a hedge in his portfolio. So if it's 2,000 or 2,100, 2,200, the point is it's inversely correlated to stocks, and that's what he needs in his portfolio. I'm talking big hedge funds, sovereign wealth, etc. We're already trading at all-time highs in 80 different fiat currencies, and we're within spitting distance of the all-time high in US dollar terms. In other words, we have created a cup and handle formation from 2011 onto here, where you created a huge shape. Then you have 4 different brushes with the resistance, which is at 2070. Once that breaks it, the upside is around $1,000 an ounce. So the move is to 3,000. That's where we're going. And then I think once we hit 2,100, silver starts to join us and actually outperforms gold. Now, don't get me wrong. My portfolio, my stocks portfolio, has done tremendously well. It was up 54% in 2023. But and your viewers can access my 2024 portfolio at wealthresearchgroup.com/portfolio. Just download it, no holds barred. You can see everything that I'm invested in. I think that this year, some sectors of the market will do well, but this is going to be a very important year for commodities, and of course for gold in particular.
I sure hope you've been stacking gold and silver, because I strongly believe they're going to break out soon. But you need to be patient, so pace yourself, and I hope your day is A-OK.